What is up, guys and girls, and welcome to DecDoesInvesting, the wealth, investing, and finance channel. Before we start, I'd like to ask you to hit the subscribe button to join me on my journey, and also hit the like button to help me out with the YouTube algorithm. In today's video, I have 3 UK stocks that are currently undervalued at the moment and a potential buy at their current price. However, I would like to point out that this video is just for entertainment purposes and this should not be taken as financial advice. As always, you should do your own research before purchasing any stocks, as your capital will be at risk. The first company on my list is Diageo, which has the ticker symbol DGE and is found on a London stock exchange. Diageo is a global leader in the alcohol industry with an outstanding collection of brands across spirits and beers. These include Smirnoff, Baileys, Captain Morgan's and Guinness, to name a few of the notable ones. Looking at Diageo from a financial standpoint, starting with its share price, we can see that from the 1 year chart back in February, Diageo was trading at £31.46, and going even further back in September, it was trading at its 52-week high of £36.26. At the time of making this video, Diageo is trading at around £27.40, which means the stock is trading at a discount of 13% in comparison to February's price and 25% from its 52-week high. Now moving on to its shareholder returns, we can see that over a 5-year period, Diageo has returned 72.2%, which betters that of its industry, which saw a return of 67.6% and massively outperforming the market of 3.7%. Simply Wall Street and their analysts currently undervalue Diageo by 2.7% in comparison to its fair value. This isn't much of a discount at all. However, with the past performance of Diageo, any discount on this stock is a steal in my opinion. If we analyse the future growth forecast of Diageo, we can see that its annual earnings growth is expected to be around 9.3%, which is slightly greater than that of its industry of 9%, but falls short of the market, which is expected to grow 19.2%. Also, its future revenue growth is expected to be 5.4%, which is slightly greater than that of its industry average of 5%, and also beats the market of 3.4%. Diageo is expected to have a future return on equity of 37.9%, which shows that management are using shareholders' capital effectively. Now analysing Diageo's past earnings, we can see that it has returned 8.4%, in comparison to the industry of 6.3% and the market of 13%. Over the past 1 year period, Diageo has returned 3.7%, in which the industry it finds itself in struggled and saw a negative return of 0.8%. This also beat the market, which only returned 3.3%. If we now look at Diageo's financial state of play, we can see that its short-term liabilities are covered. However, its long-term liabilities of £13.7 billion are not covered. Finally, moving on to Diageo's dividends, we can see that it currently has a yield of 2.5%, which is only slightly higher than the lowest paying 25% dividend paying companies, and is also lower than its industry average of 2.6%. Diageo's dividend yield is, however, forecasted to grow to 2.7% in the next 3 years. Finally, wrapping up, we can see that Diageo's current payout ratio is a very good 54%, and this is expected to fall to 53% in the next 3 years, which shows that its dividend is well covered and safe. The next stock I have on my list is Greggs, which has the ticker symbol GRG and is listed on the London Stock Exchange. Greggs is the largest bakery chain in the United Kingdom, and it specialises in savoury products such as bakes, sausage rolls, sandwiches and sweet items. If we take a look at the 1 year chart of Greggs, we can see that on the 20th of February it was trading at £24.40 and almost at its 52-week high of £24.76. Whereas at the time of making this video, it is currently trading at around £15.40. This means at its current price, you can pick up Greggs for a discount of around 38% in comparison to its 52-week high trading price. Taking a look at the shareholder returns, we can see that over a 5-year period, Greggs returned 51.6%, which bettered that of its industry, which returned a negative return of 6.4%. It also outperformed the market, which only returned 3.7%. Simply Wall Street and its analysts currently undervalue Greggs by 35.9% in comparison to its fair value, which means there is a very good discount to be had right now, made even better by the fact that it's a company that is ever growing and expanding. If we now look at Greg's forecasted annual earnings growth of 4.5%, we can see that this lags the market of 19.2% and also its industry of 24%. On the other hand, Greg's has a forecasted revenue growth of 4.4%, which is both greater than its industry and the market, which are expected to return 4.2% and 3.4% respectively. Greg's has a future return on equity of 22.4%, which again shows the management are using the shareholders' capital effectively to grow the company. Looking at Greg's past growth analysis, we can see that over the past 5 years it grew 10.7%, which is greater than its industry of 9.1%, but below the market of 13.3%. However, over the past year, Greg's has smashed both the market and its industry. Greg's has grew its earnings by 32.5%, where its industry negatively returned 10.9% and the market only saw a 3.2% increase. Moving on to Greg's financial health, we can see that it doesn't cover its short-term liabilities of 208.7 million, nor its long-term liabilities of 233.3 million. Therefore, we must take this into consideration before investing into Greg's. Now at the moment, Greg's has suspended its dividend, and therefore I can't give you any analysis on its dividend yield. However, we can look at 2019's dividend, in which it paid a dividend of 0.357 pence per share, which gave it a yield of 2%. From this graph that we can see year on year Greg's had increased its dividend payments. Therefore, long-term investors like myself would expect to see the dividend return once the economy picks up and rise year on year once re-established. Finally, the last stock I have on my list is JD Wetherspoons, which has the ticker symbol JDW and is traded on the London Stock Exchange. Wetherspoons operates nearly 900 pubs, including a chain of Lloyd's No. 1 bars and a growing number of Wetherspoons hotels. So starting with Wetherspoons' share price, over the past year we can see that it was trading at £15.58 on the 5th of February and had a 52-week high of £17.34. At the time of making this video, Wetherspoons is trading at around £8.70, which means there is a discount of 44% to its February trading price and a massive 50% from its 52-week high. If we now move on to its shareholder returns, we can see that over the past 5 years, Wetherspoons has returned 15.4%, which betters that of its industry, which returned a negative 6.4%, and also beats the market, which returned 3.7%. Simply Wall Street and its analysts currently undervalue Wetherspoons by 50.9% in comparison to its fair value of £17.71, which is a huge discount for a company of Wetherspoons' brand recognition. When it comes to Wetherspoons' forecasted annual earnings, we can see that it's expected to grow a whopping 70.9%, which smashes its industry of 24% and also the market of 19.2%. This is also reflected in Wetherspoons' forecasted annual revenue growth of 11.4%, which again massively outperforms its industry of 4.2% and the market of 3.4%. Now analysing Wetherspoons, over the past 5 years, we can see that it's had an annual earnings growth of 9.9%, which is greater than its industry of 9.1%, but falls short of the market, which grew 13%. Now looking at earnings growth over the past year, we can see that Wetherspoons had a negative earnings growth of 3.5%. However, this was better than its industry of negative 10.9%, but less than the market, which grew 3.2%. If we now move on to the financial position of Wetherspoons, we can see that it doesn't cover its short-term liabilities of 381.6 million, nor its long-term liabilities of 1.5 billion. So this must be taken into account when assessing whether or not you decide to invest in Wetherspoons. Finally, wrapping up Wetherspoons' analysis and its dividend, or should I say lack of dividend, Wetherspoons suspended its dividend and therefore currently doesn't have a yield. However, looking at the past dividend payments from Wetherspoons, we can see that it's paid a dividend for over the past 10 years. The yield, however, wasn't particularly great, as in 2019 the yield was 0.8% and the dividend per share remained 12p throughout this period. In my opinion, Wetherspoons is more of a growth stock and more for capital appreciation than the dividend it will potentially pay in the future. So that wraps up my video on 3 UK stocks to buy now. Leave a message down below whether you own any of these stocks or you plan to purchase them in the future. So thanks for watching, guys. If you've liked the video, please drop it a like. Subscribe if you want to see more content like this, and be sure to hit the notification bell to be notified whenever I upload a video. And if you've missed any previous updates, there'll be a link to the playlist in the description down below. And until next time, peace.